Hi, so welcome to this. Hi, so welcome to the stream this evening as we turn our attention to public sector accounting and finance. 9 a.m. tomorrow, you're going to be taking that, and then for those of you doing financial management as well, that's also 2 p.m. tomorrow. In that case, so 9 a.m. tomorrow for public sector accounting and finance, and then 2 p.m. to financial management. So we want to spend the time to look at the various things that we need to really look out for, and then try to revisit some of the things that we need to look out for, key things that we need to focus on to increase our chances of passing the examination. And as we have been saying all this while, public sector accounting and finance is one of the easiest papers that you can pass in the whole ICA examination, because I mean the structure is pretty simple. We know everything that is going to be in question 1, question 2, question 3, question 4, and we know how the structure of the questions are going to be. So all I'm going to do this evening is to just share our thoughts quickly, and then answer any questions that you might also be having when it comes to dealing with public sector accounting and finance. And then in between, if there are any financial management questions also, I may be able to address that as we go on in the discussion generally. So that is the issue that we want to look at this evening. But before I get excited to, spend some time to talk, if there are any questions, something specific that you would want me to share my thought on, you can raise your hand. I bring you up. Those of you who are with me on Zoom, and I'll put it in the chat for me. Then, for those of you joining us online on the various platforms, Facebook and YouTube, also, you can put it in the chat or the comment section for me. I'm going to be answering all your questions for you as we try to wrap up on public sector accounting and finance. So, any questions for me, something specific, you raise your hand, I'll bring you up, or you put it in the chat for me on Zoom, on YouTube, as well as on Facebook as we move ahead with our discussion. Let's see, what do I have here? Okay, that's better. Okay, so it means that uh, nothing specific for me. So I'm gonna just try to see if I can walk through the various issues that we need to look out for, and then paying attention to the context and the structure of the question and what we are expected to talk about or write about generally as well, so that we can see what we need to look out for. So let me quickly bring up my screen, and let's go. So in the public sector accounting and finance examination, we know question 1 will be coming from these 5 areas. 2 of these 5 areas will be in the exam hall for 20 marks. Okay, something about measurement basis, accounting basis, accounting techniques or approaches, qualitative characteristics of financial statement, and then possibly some IPSAS issues. So at least 2 of these will be in the exam hall for question 1. Whether I like it or not, that the examiner is going to be asking you about, that you must definitely know about when it comes to the examination. So 20 marks waiting for us in the exam hall on question 1. Now, when it comes to the concept of measurement basis generally, when it comes to the concept of measurement basis, what's going to be happening is that there are 2 ways that the examiner is going to be pulling the question to us when it comes to the measurement basis. It is either the examiner is going to just access to comments, on the measurement basis that an entity can use, or the examiner is going to give us some transactions, and then he will ask us to state the appropriate measurement basis for that particular transaction. All right. So that is the first thing we need to understand. If we are going to talk about measurement basis, then this is how the question is going to be coming. Either we're going to just be writing, explaining the measurement basis in general, or the examiner is going to be getting excited and then stating some transactions and then asking us what will be the appropriate measurement basis that we need to talk about. And so when it comes to the measurement basis, we know the measurement basis already. I mean, historical cost, fair value, and all of those things. We know them, and we've spoken about these over and over again. Historical cost, that is the initial amount at which an asset can be recognized. That is the amount transferred in order to acquire an asset, or the amount due to be paid to settle a liability. And so that is historical cost. So, for instance, when an entity develops a software in their by themselves, then the appropriate measurement basis for that particular software will be the historical cost, which means looking at the cost that the entity has incurred in putting together or developing the software. So that is the first thing that we need to understand. Or the entity constructed a warehouse or constructed a building by themselves, then by default they are supposed to initially carry that building that they just constructed on what we refer to as the historical cost. So that is what we call the OG measurement basis that we need to generally know about. Then we come to the concept of fair value. Fair value is simply the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. So the fair value has to do with, okay, that the asset that we have now, how much can it be exchanged for? A liability that we have now, how much do we have to pay to settle it? That is the fair value. Then we have the issue in relation to the replacement cost. The replacement cost, as the name suggests, is an existing asset that the entity is having. How much cost will the entity incur in order to replace that asset in today's term? So probably they bought the asset 10 years ago or maybe 5 years ago. The amount they paid in acquiring the asset 5 years ago is referred to as the historical cost. Then in today's term, if they want to get that same asset of the same productivity level, how much are they going to pay for it? That is going to be the replacement cost. Then we also have what we call the net realizable value. The net realizable value is simply going to be the fair value less cost to sell. In other words, if we have an asset as an entity and we don't want to use it and we want to sell it today, how much are we going to get less any cost that we will incur in disposing of that particular asset? That is the net realizable value, and usually that is going to be common measurement basis for inventories, and that is in respect of IPSAS 12 inventories, because in accordance with IPSAS 12, what is going to be happening is that the valuation of inventory depends on the usage or the purpose of the inventory, and you need IPSAS 12 because 99.9% of the time the question 2 that is going to be coming, there is something about inventories that you need to know about. So IPSAS 12 inventory is a fundamental issue that you need to understand because of question 2 exclusively. Now, when it comes to the inventory accounting, if the inventory is disposed, okay, or maybe sold at a fee, or maybe distributed at a fee, meaning that the entity is selling that inventory to get some money, okay, it means that inventory will be valued at lower of cost or net realizable value. Okay, we value it at cost and lower of cost and net realizable value. So the net realizable value as a principle will work usually when it comes to dealing with inventories that the entity is going to sell, or they distribute it at a fee. Not necessarily at the fair value. Even if they distribute it at a discounted price, it is still going to be valued at value lower of cost and net realizable value. But then, if the entity receives the inventory and they are, using the inventory in the day-to-day running of the organization, so they are using the inventory for admin purposes, or distributed at no charge, then such inventories will be valued at lower of cost or replacement cost. Lower of cost or replacement cost. So for instance, like if Christmas is approaching and there's going to be a lot of events coming in during the holiday season, so the Ghana Health Service decides to, buy some condoms, and then, they share the condoms and other forms of contraceptives so that we can prevent useless pregnancies and foolishness in respect of sexually transmitted diseases. They buy the condoms and then they distribute those condoms at no cost. All right. How do we account for those condoms? It will be accounted for at lower of cost or replacement cost. It's simple as that. They didn't sell the condoms. What they want to prevent malaria, so they buy mosquito nets and then they distribute the mosquito nets across the country. All right. The inventory or the stock of the mosquito nets will be valued at lower of cost or replacement cost. So IPSAS 12 is a fundamental accounting standard that's going to be playing a key role when it comes to the question 2, the preparation of the financial statement. Because one way or the other, whether we are on a consolidated level or we are dealing with a covered entity, they will have one of these two inventories somewhere which we have to value, or possibly they will have all the two available, and we have to know the figure at which we are going to be valuing the closing inventory. And that value of the closing inventory will be subtracted from goods and services and taken to the statement of financial position under current asset as the stock of inventory at the reporting date. So that is the concept of the net realizable value. Now, that doesn't mean that is the only point that a net realizable value can be used. It can be used also in respect of assets, and then testing for impairment of assets generally in that regard. But that is the net realizable value, and that is how it applies. Then we have the present value. I mean, like it says, if we decide not to sell the assets today, because when we decide to sell the asset today, that is the net realizable value principle that will come in. Then we will use the net realizable value to probably value the asset. But then if we want to continue to use the asset, then we can use the present value method to value the asset, and that is to discount the future cash flows. All right, we discount the future cash flows from the continuous usage of the asset using the cost of capital of the reporting entity under review. So that is the idea about measurement basis. And so, like I said, the examiner can just ask you about comment on the measurement basis that an entity should use, and you just comment on it. You write notes about it, or we are going to be given a transaction. Maybe the entity is transitioning for the first time from the cash basis of accounting to the accrual basis of accounting, because remember, this year is the final year that Ghana was supposed to transition to the full accrual basis so that by 2024 it becomes operational. But because of some administrative challenges and other things, not all covered entities have been transitioning to the full accrual basis. So the examiner can throw as a question where an entity which has been using the cash basis of accounting is now transitioning to the usage of the accrual basis of accounting. And so when that happens, they have to revalue all their assets. And so then we would have to be asked, what will be the appropriate measurement basis to value those assets? Another example of that is also if, let's say, a covered entity received, donations. then we have to find out what measurement basis are we going to be accounting for that. So say donations in kind. How do we account for that? You know the way we account for these things. So these things are in the final accounts, question 2, as well as applicable in question 1. So for instance, if the covered entity receives a vehicle, okay, or a plant, how do we account for this in the financial statement? That is a donation. And so we have to value these plant or vehicle will be carried, okay, at the fair value at the date of the donation. The fair value at the date of the donation. Please note this is question 2. These items are question 2 items, and they can also be in question 1 under measurement basis item. So you need to make sure you understand what the heck is going on here. So the vehicle that has been donated to the covered entity is a donation. So they will have to value it at what? The fair value at the date of the transaction. But what is the double entry then? You know that already. We're going to debit, because it's a plant, we're going to debit non-financial assets with that fair value, and then we'll credit revenue. But we don't credit revenue necessarily. We're going to add it to donations. Okay? We add it to donations and other benefits that the entity is getting. So that is the way we account for the initial measurement. Then on subsequent measurement, as that vehicle is being added to non-financial assets, or what you will also call non-current assets, depreciation would have to be charged on it, or consumption of fixed assets will be charged on it, which will be taken to the P&L, which will be taken to the statement of financial performance, so that the carrying amount would then go to the statement of financial position. So when the entity receives vehicle donated to them, then this is how we account for it on the initial measurement and on the subsequent measurement. It is important you understand some of these transactions, not restricted to what I'm saying here, but you have to understand transactions on initial measurement and subsequent measurement, because that is very important. Now, what we just look out for here, the kind of revenue that we are recognizing here, that donation in kind is actually an accounting standard, and that is IPSAS 9, revenue from 23, revenue from non-exchange transaction. Okay, revenue from non-exchange transaction. IPSAS 9 is revenue from exchange transaction. This one is non-exchange, meaning you receive something without paying anything for it, or without giving anything in return. So that is revenue. That is why it is part of donations, but it will be the asset to be recognized. Then on subsequent measurement, that asset will apply IPSAS 17, property, plant, and equipment. That is why we will charge consumption of fixed assets or depreciation and take it to the statement of financial performance, the depreciation, then the carrying amount will go to the statement of financial position. So that is an example of how the treatment will be done. Or let's say that they received, that's another example. Maybe they received inventory. Okay, they receive inventory. It's a donation though, but it's stocks. Stocks of what? Condoms, like I said, sanitary pads. Okay, what else? Other contraceptives. Okay, they receive some of these things from donor partners, so that we reduce the foolishness in terms of pregnancy and STDs. Okay, it's a donation. How do we account for it? The same thing. The stocks of things are inventories, so we're going to debit our inventory. At what value? At the fair value at the date of transaction. Okay, so we value it at fair value at the date of the transaction. Then we debit inventory with that value, and it's a donation we got. Okay, it's a donation we got. So we're going to credit revenue, which simply means add it to your donations. Okay, because some of you, when we do double entry like this, then your brain is going bananas. But that's the meaning of that. So you just add it to your donations. Now, that is initial measurement. Now, on subsequent measurement, the inventory will be accounted for in accordance with IPSAS 12, as I spoke to you about that here. So we're going to be applying IPSAS 12. So if the sanitary pads are going to be distributed for free, then it means that the sanitary pad will be carried at what? Lower of cost and replacement cost. But if it happens that the things that we received as a donation, we won't distribute it for free, but we will sell it. Then, on subsequent measurement, in accordance with IPSAS 12, it will be accounted for at what? Lower of cost and net realizable value. Lower of cost and net realizable value. So that is another scenario there that we need to understand when it comes to dealing with all of these items. So like I said, these are dedicated questions that we can have in question 1 in respect of measurement basis, where IPSAS is following us and measurement basis is in town. Or these will be notes to the financial statement preparation in question 2, that you have to know the initial measurement treatment and the subsequent measurement treatment. Another thing that I could bring up still from the donations is if maybe we didn't get vehicle, we didn't get sanitary pads and all those condom stuff, but maybe we get skills, expertise, okay? Skills or expertise. So, whatever. What is currently prevalent in Ghana? I don't know, whatever the heck. Let's say that we receive some medical doctors from, Cuba or from the United States from the United Kingdom, and they come. It's a form of donation, so they are sent by the government there to come and help the country to deal with a certain pandemic or whatever the heck. How do we account for that? Again, the experts will be valued at fair value. Okay, so how much would we have paid if those guys are coming in? So we have to value the experts, the service that they are providing us at fair value. And here, it's a skills that they are offering to us, so we cannot recognize any assets like we did for the inventory and we did for the vehicle. So here, what's going to be happening is that you recognize revenue and you recognize expenditure. That's it. So technically, you're going to debit expenses. Okay. Now, when I say debit expenses, technically, it means that you're going to be debiting social benefits, because that's a form of social benefits that the government is undertaking or the entity is undertaking. So when we say debit expenses, what we mean is that fair value that we got for the skills people value will be added to social benefit as part of our workings flow. Remember, classification of items are very important. So if they receive donation of a vehicle from an NGO, and you go and add that money to decentralized transfers in the case of covered entities, your revenue total is going to be correct, but the individual figures will be zokpo. So classification is very crucial here. So in the context of this, it could be put under social benefits, because it's something that the government is doing. They will recognize revenue, but certainly it's not revenue we're going to recognize. It's going to be in a case of donation. Okay, so it's going to be added to donations and grants as well in that case. So when we say measurement basis, that's what we're talking about. Either we are going to be writing stories about what the heck they are, bam, 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 and get away from there, or transactions are going to be given, and the examiner is going to be asking us to advise the company what will be the appropriate measurement basis for them to carry the transaction at the initial measurement and the subsequent measurement. And it is important you understand. So these are just 3 scenarios that I'm giving you, but I hope you get the idea about how some of these things will happen at the end of the day. Now, if it happens that the covered entity is unable to value the skills or the support given to us, that means we cannot put any figure on it. So in that case, it will be disclosed in the notes to the financial statement. So as part of our working flow, as part of the notes to the financial statement, we just disclose it in the notes because there's no value that can be put into onto that particular service. But 99.9% of the time, there is a value that can be placed on the service that these people are offering us. So that is the first thing that we need to understand. So although I'm in question one and I'm talking about measurement basis, you see the way understanding measurement basis actually transitions to question two, the 20 mark area for financial statement preparation. And so that is why I keep on telling you that public sector is very easy to pass. If you understand the way the things are arranged and the way they are, you're not going to struggle. You're not going to struggle. And that is the idea about measurement basis and what you need to understand. And that's the first thing in question one that the examiner could share some light on us. Like I said, even if you learn it and we don't get it in question one, whether you like it or not, it is waiting for you in question two, where you're going to apply the measurement basis principle to prepare the financial statement. So either way, your best bet is to know it. Then we go to the second part, and that is going to be the accounting basis. I mean, we don't need a miracle for this one. Cash basis, accrual basis, modified cash basis, modified accrual basis. I mean, we don't need a miracle on this ones also. But that's the second category for question one that the examiner can visit us from. So accounting basis. Okay. The accounting basis focuses on how revenue and expenditure is recognized. Very important. How revenue and expenditure is recognized. How do we recognize revenue and expenditure? So, number one, cash basis. Under cash basis, revenue and expenditure is recognized when cash is received in the case of the revenue and when cash is paid in the case of expenditure. In other words, revenue and expenditure is recognized evidence with either the receipt or payment of cash. That is the cash basis of accounting. Now, it is important you understand the merits and demerits. My time will not allow me to go through that, but as you read under the accounting basis, make sure you understand the advantages and disadvantages of the basis of accounting, because that could play a key role in the exam hall and the examiner could throw you something about that. The beauty of this part is that the examiner could ask you to compare and contrast the cash basis of accounting and accrual basis of accounting. Now, when the examiner asks you such a question and you're comparing and contrasting the accrual basis of accounting and the cash basis of accounting, what you're going to be doing is to use the advantages and their disadvantages, because the advantages of the cash basis of accounting become the disadvantages of the accrual basis of accounting, and then the disadvantages of the accrual basis of accounting becomes the advantages of the accrual basis of accounting. So that is the idea that you must understand generally, but that is cash basis. Right opposite to that is the accrual basis of accounting. Here we recognize revenue and expenditure not when cash is paid or received, but when the transaction takes place. That is the accrual basis. And that is the generally accepted model or mode of recognizing revenue and expenditures in the books of an entity, because it shows the true picture of transactions. Assets are not written off like in the case of cash basis. Assets are capitalized and depreciation is charged. Provision is made for expenditure and bad debt, but in cash basis we are not going to be having any of that coming in. But that is the accrual basis. But you see, it is difficult to take people from cash basis and then boom to accrual basis. That is a 180-degree change. So although our goal is to do a 180-degree change, move from cash to accrual, we want to take the journey a little bit. So we will do a 90-degree change, and that is where we hear of the modified cash basis. So under the modified accrual first, let me do modified accrual because of the scenario I gave. So under the modified accrual basis, this is where we are going to be using two separate accounting bases for the recognition of revenue and expenditure. Two separate accounting bases for the recognition of revenue and expenditure. What does that mean? It means that we recognize revenue using the cash basis, we recognize expenditure using the accrual basis in the financial statement. And that is the idea about how we can deal with that. Give me a sec. All right. So that's modified accrual basis. Revenue is recognized on cash. Expenditure is recognized on the accrual basis. And that is a 90-degree turn. So that when people become familiar with the accrual basis bit on expenditure, then we can then do the additional 90 and bring the system to a full accrual basis. So it's like a baby step that we let cash basis people take to introduce them to the accrual basis, but on the expenditure side, so that once they are familiar with that, boom, we can now do the 10 and then take them to the full accrual basis. Then the last thing is that, when we use the cash basis of recognizing revenue and expenditure, what happens is that there are some times that certain transactions have occurred during the year, but payment had not been made for them, or payment will be made for them, or the cash will be received immediately after the year end. When that happens, it means that really the financial statement we are preparing doesn't really give a true picture of the transaction or the economic phenomenon of the transactions that took place during the year. So in order to, be able to capture some of these transactions that happen immediately after the year end, we can then go to what we call the modified cash basis. So this is where it's just like the cash basis. We are recognized revenue and expenditure when cash received or paid. But the distinction here is that the books are left open 3 months after the year end to be able to capture transactions for payments that were supposed to have been made in the year before we ended, or amounts that are supposed to have been received which were not received as at the year ended. So these are the accounting bases. We use these ones for recognizing revenue and expenditures. Two things will happen again here. Either the examiner is going to be asking you to tell him a story. So just comment, compare and contrast one of the methods over the other. Talk about the advantages or disadvantages of the other. What are the limitations of one over the other? That's one way the examiner is going to be setting the questions. Or the examiner is going to present you with some transactions. Then for the transactions, he's going to ask you, if it is cash basis, how do we account for it? If it's an accrual basis, how do we account for it? That is it. That is it. So just like the measurement basis, comment on the item, bam, bam, bam theory, and get the heck out of there. A transaction could be given to you, then you have to state the appropriate measurement basis. The same thing could happen to us on accounting basis. Either we're going to be writing theories, bam, 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 and then go away, or transactions are going to be presented to us, and we have to be able to tell which accounting basis will be used to account for these particular transactions in the books of the entity and how it will be presented. So that is the second issue that we need to understand, accounting basis. Again, you need to understand this very well because you need these principles, especially whatever accrual basis and then modified accrual in question 2, financial statement preparation. Because you need it there so that if the covered entity is using the modified accrual basis to prepare financial statement, which the examiner has not done before, usually whatever question that comes, the entity is using accrual basis of accounting. But I have told you, we will get to question 2 in a moment, but if we are going to be using modified accrual basis to prepare the financial statement, that means when it comes to the footnote, any revenue that is outstanding in the footnote will not be added to the revenue, because under modified accrual basis, revenue is recognized on cash basis. It is the expenditure that will be recognized on the accrual basis. So you need to understand this, because a dedicated question can be set on it for you to comment and tell us stories, or transactions are going to be given where the examiner will ask you under the accrual basis, how the heck do you account for this? Under the cash basis, how the heck do you account for this? Or you will need the principal to be able to do well in question 2, which we will get to in a moment. So again, you are seeing the transitioning. You are seeing that nothing you are learning is actually garbage, because whatever you are learning, measurement basis, accounting basis, you need it in the question 2 anyways. So whether it comes as a dedicated question or not, the principle will be applied some way, somehow in question 2. Okay, so that is the idea about the second issue, accounting basis. Then we come to the third one, and that is accounting techniques. Okay, accounting techniques. Or approaches. Accounting techniques or approaches. Now, whilst the accounting bases are for recognition of revenue and expenditure, the accounting techniques are for bookkeeping, recognition of transactions in the books of the entity. Okay, so these are for bookkeeping purposes. Recognition of transactions in the financial statements of the entity. So it's important you know the difference. So under the accounting techniques or the accounting approaches, which is also a dedicated question that the examiner can present to us, we can have what we call the vote accounting or appropriation accounting. Now, as you know already, a vote or an appropriation is simply an approved expenditure by Parliament. So under vote accounting or appropriation accounting, the entity is going to be preparing the set of the books or recognized transactions based on the budgetary estimates approved by Parliament. Okay, based on the budgetary estimates approved by Parliament. Based on the budgetary estimates approved by Parliament. And so we're going to be having the accounts for each of the votes. So for instance, we can say that, all right, free SHS, how much the heck did the government approve for free SHS? Okay, did Parliament approve for free SHS? Whatever the heck, let's say 10 billion Ghana cedi. All right, so it means that we're going to be preparing the set of financial statement in respect of this vote. That's vote accounting. That's vote accounting. So it's going to be specific for the votes that we are spending. Okay, planting for food and job. How much the heck did Parliament approve? Okay, let's say 1.5 billion. All right. So all the expenditures that relates to planting for food and job is going to be captured under that expenditure vote in the books of the government on the consolidation level at the end of the day. So that is the concept about vote accounting. Now, it is important that you understand the features of vote accounting, the advantages and disadvantages. Make sure you read those things because it's something that the examiner can throw at you. It helps in budgetary estimates. It helps in the controlling of the budget and over expenditure in the public sector, because now that we are keeping the records based on how much that has been approved by Parliament, it means you cannot go beyond the budget that has been approved by Parliament. So that is one of the ways that transactions are going to be recognized, books are going to be kept by the covered entity. vote or appropriation accounting. Then we go to the brother of this, and that is going to be commitment accounting. It's my personal favorite, commitment accounting. Here, we're going to be recognizing transactions, and please note that commitment accounting is purely for the recognition of expenditure items. Very important. It's strictly for expenditure items. Hence, we recognize an expenditure evidenced by the award of a contract. So either we have awarded the contract, okay, or possibly we have, send a purchase order to the supplier to supply us with something. So once we have signed a contract or sent out a purchase order, boom, that expenditure is going to be accounted for. Now, the way the commitment account works is that once we signed the deal, what's going to be happening is that we're going to be moving the money from the vote, which is approved by Parliament, to the commitment account. And the purpose of it is to hold that money, quote unquote, in the commitment account, because now we have awarded a contract, we owe. We have sent out a purchase order, we owe. So we remove that money from the vote so that we won't get any ideas to spend anything again. So for instance, if we come back here, whatever the heck, let's say that Ghana Health Service, we have approved a vote of whatever the heck, let's say 1 billion for them. Okay, then during the year, they have awarded a contract for what? For some mosquito nets, for some condoms, for some sanitary pads to be supplied to them. Okay, how much is that? Okay, the supplier has estimated that that is going to cost us 100,000 Ghana cedi. All right, they're going to move that 100,000 from the 1 billion votes and put that in the commitment account to hold it. To hold it. Now, when the goods are received or the service is rendered and we inspect and find out that everything is okay, because remember, we solved the question during the mock where we spoke about the procedures we go through before making payment. You remember those stages we went through. So once the goods are delivered or the service is rendered, what's going to be happening is that we are going to go through those procedures. Then we can move it from the commitment account into the expenditure account. And that's the idea about how the commitment account works. So once we have awarded a contract, once we have sent out a purchase order, we move the money from the vote, put it in the commitment. When the goods is delivered, boom, we go to the expenditure account. Now, a couple of things you got to just understand. If it happens that the money we set aside in the commitment account, when the goods are delivered and we receive an invoice above the money that we had set aside, the excess will come from the vote. Which makes sense, isn't it? So for instance, we earlier thought that we're going to pay $100,000 for the condoms and the sanitary pads that had been procured. But the invoice came and they are like, oh, don't you know that some people are fighting somewhere? So, 120,000 Ghana cedi now. Okay. Now, we set aside 100,000. So we're going to move that 100,000 from the commitment to the expenditure account. But the excess 20,000 will come from the original vote into the expenditure account so that we can get a whole amount there. Now, if it happens that for some miraculous reason, we received the goods, it was what we wanted, in the quantity we wanted, with the quality we wanted, but the invoice is below how much we had originally set aside, then the excess will revert back to the vote. That's the idea about that. So that's the concept about commitment accounting. This one also helps in the treasury management of the government, because it helps so that yes, we have approved 10 billion for free SHS, but we have awarded a couple of contracts. So right now, how much do we have in the free SHS votes? Okay, right now we have like maybe 1 billion left from that out of the 10 billion. Okay, that means we can only award up to 1 billion contract again to prevent overspending. So it helps in treasury management generally when it comes to dealing with public sector accounting and finance. Then we go to the next one, fund accounting. Now, there are a lot of funds of government. So, fund accounting is simply keeping separate books of accounts for all the public funds of government, for each public fund of government, so that at the end of the day, we'll be able to know the assets and the liabilities of these funds. That is fund accounting. So, if you're a good student, you remember that we mentioned that the public fund of Ghana shall be the consolidated fund, the contingency fund, and all other funds like road fund, okay, get fund, petroleum fund, you know, uh, whatever the heck fund, COVID, whatever fund. All these funds have been collateralized. They've used all of them for loans. I mean, that's where we are. So, I mean, if your road is not being fixed in your community, the road fund, there is no money in it. They have already taken the money to do other things. So when the money drops in it, they use it to repay the loan. Get fund, the same thing. Majority of the money has been collateralized already. So when the money drop inside, boom. So if you have somebody outside and they are on scholarship and government is not giving them their scholarship or the money that they need to be using, is because the get fund shkabemi. So that's the idea. But fund accounting means that we are going to be preparing separate books of accounts for each of these funds. So that at the end of the year, we're able to know, okay, on our get fund, this is the liability we have, this is the assets that we have on the get fund. That is the principle on fund accounting, or that is the explanation of fund accounting. We are keeping separate books of accounts for each public fund because the public funds, or the fund is treated as an economic entity separate from others, and that is one way we can account or recognize or keep our books as an entity. So, vote accounting based on budgetary estimates, commitment accounting solely for expenditure item. Hence, when we award a contract or send out a purchase order, boom. Then, fund accounting, we're going to keep a separate books of accounts for each of the public funds of government. Then we can talk about some other ones like whatever the heck, environmental accounting, and all that. Environmental accounting is simply the incorporation of the environmental impact in the financial statements of the government or of the covered entity. So that's environmental accounting. So for instance, Ghana recently got lithium. We discovered lithium, and then, as in the fashion of our country, they've given it out already, and so it's gonna be mined and taken out, and all that. Now, Ghana is going to be getting some money because, yes, definitely they say we have some 15% share in the lithium plus other royalty benefits. Now, that is inflows coming into the country, right? It's money coming in. It will help governments to, pay for various other expenditure items. But the question is, what is the environmental impact of lithium mining? Okay, so trying to find out, okay, the habitat there, they're going to destroy the habitat. Okay, what will be the cost that government is going to be incurring to restore the environment, to restore the habitat there? So the cost that government incurs in restoring the environment and making sure that we continue to have environmental sustainability and reduce climate and global warming and all those things going on is called environmental accounting. So the tree planting things that they do in this country, all those things are going to be captured under environmental accounting. And these are what we refer to as accounting techniques or approaches. These are used for bookkeeping, recognition of transactions in the entity's financial statements. And remember, all of these are made possible, plus the accounting basis, recognition of revenue and expenditure, through the gift miss. the Ghana Integrated Financial Management Information System. And it is important you read that. Time may not allow me to go through that with you, but make sure you read that before you go to the exam, or because I don't know, probably the examiner can get some goosebumps and, send you some flowers in respect of gift me. So you want to make sure that you read that before you get into the exam hall. So that is the idea about accounting techniques or accounting approaches. Any questions? Raise your hand, will bring you up, or you put it in the chat for me if you're also online. Okay, so seeing some comments coming in on YouTube, let's see if I can look at that briefly, and we go away. Well, let's see, what do I have? Also, then David Holali. Hi, say hello, David. Afiche said, good evening, sir. Good evening, Raymond. And then he said, please, when are you starting classes for the March date? We are starting classes on 4th December 2023. I wanted to say 2024. It's like, I'm in hurry already for 2024. I don't know. Probably I have something important to do in 2024. But we will start on 4th December 2023. But registration is ongoing. In other words, you can register now and start studying before the live lectures, because when you register, you get access to our previous lecture videos, question kits, and everything to be able to start studying even ahead of the live lectures. So you can register now, actually, and you can send us a. You're going to have a strange thing dropping for you for between 2 to 5 marks, which means you're still going to have the 15 marks in respect of the 2 of the 5 things we've spoken about already. Then you have 2 to 5 mark question coming in from some introductory discussions, like, users of financial statements in the public sector. You know these things already. I'm not the one to tell you about them. You know them. And their information need. You know them already. Then maybe the roles of a certain person, maybe the internal audit agency, the controller, accountant general, the finance minister, whatever the heck, parliament, or something. So sometimes the examiner is gonna, get that feeling and try to flex with you a little bit in the question 1C by bringing between sorry between 2 to 5 mark question on something about users of financial statements or role of various, regulatory authorities in the public sector. It's a fundamental issue that the examiner will sometimes throw at you in the question 1. I am telling you, so that if you go there, you see that you say, oh, insurance said that, question 1, these are the things that are going to come. Look at what the examiner did. No, I know what the examiner can do. That's what I'm telling you ahead of time. So when you go there, you see question 1C, and it's about users or role of something. It's an introductory discussion, or even objective of financial reporting. Objectives of financial reporting. You remember we discussed that during our mock discussion. All these are introductory discussions, or how government controls public sector organizations. We discussed all of these things during our mock discussion. So all these things are introductory issues in public sector that the examiner will sometime, because he is excited about the exam, bring between 2 to 5 marks for you in these introductory issues. Whatever be the case, we're still going to get our 15 marks in either 2 of the 4 issues that we have spoken about. But that is question 1, and that is what you need to understand there. We're done with question 1 here. Okay. Then we go to question 2. Question 2 is going to be preparation of financial statements. And there are 3 options available to the examiner, all of which he has examined over and over again. So all you need to know is to understand the principles, them, and go away. Either we're going to have it on a consolidated fund, We're going to have it for a ministry, department, or agency, or a metropolitan, municipal, or district assembly, or we're going to have it for other covered entities like a public hospital, a public school, a public transport company, or any other covered entity out there. All right? These three, one of them will be there. But the whole deal is for you to be able to understand two things generally. Number one is this topic, revenue management and expenditure control. And I told you to make sure that you rewatch that topic. I hope that you listened. I hope that you have done it. If you have not done it, I don't know. You're on your own. It's not my duty to teach you revenue management and expenditure control right now because I can't do it. Then the IPSAS going to be playing a key role here. We've spoken about IPSAS 23, recognition of revenue from non-exchange transaction. IPSAS 9 is there, recognition of revenue from exchange transaction. IPSAS 12, inventory, I've spoken to you about that. IPSAS 17, property, plant, and equipment, I've spoken to you about that as well in that particular case when it comes to dealing with those issues there. So that's the idea about question 2. All you need to understand is to know where the heck you are coming from. That's all. So when it comes to the revenue classification, like we said during our mock discussion, all we need to know about is if it is a central government, it means we are dealing with a consolidated fund. If the financial statement is on the consolidated fund, then certainly we are going to be dealing with what? Direct taxes, okay? Indirect taxes, which will actually bundle together to tell us about tax rev, okay? But it will be separated like that. Then we'll have non-tax rev, all right? Then grants and donations that the government receives. So that's on the consolidated fund. But if we are dealing with any covered entity at all, then their revenue sources will be divided into 3. Like I told you, this classification is important. If you screw up the classification, you have screwed up everything and you are on your own. Nothing can be done about that. So for covered entities, we're going to have decentralized transfer. How much money they got from the central government, either as a direct payment to them or when the central government makes payments on their behalf. You remember I explained this to you during our mock discussion of question 2. So decentralized transfer, either money that the central government wires to them so that they can use to finance their activities, or the central government makes a certain payment on their behalf. Remember we said when the central government makes payment on behalf of a covered entity, the transaction is treated twice. One, it will be added to their decentralized transfers as revenue, and then 2, that item will be recognized as an expenditure. So that is the idea about the decentralized transfer. So 2 things, either the central government is giving them money or the central government is making payments on their behalf. If the central government is making payments on their behalf, then it is treated twice. One as a revenue under decentralized transfer, and then it will be part of the expenditure of the covered entity. And that is based on whatever thing the government paid on their behalf. If it was employees' salary, then under the expenditure, it will be part of their compensation to employees. If it is goods that the government bought on their behalf, then it will be part of their goods and services. That is the idea about decentralized transfers. Then we come to the internally generated fund. These are the revenues that the covered entities generate on their own. If you remember, we said we have to categorize these revenues into the various categories: licenses, investment income, rates, and other miscellaneous fees. Licenses, investment income, rates, and other miscellaneous fees. And like I said, in case you just screw it up and bundle all of them under internally generated fund, it's okay, It's okay. The figure is going to be correct, but you're going to lose some professional marks because you did not do the categorization right, like what you saw in the mock, and we explain in the mock as well. So decentralized transfers, we must know how we do that. IGF, what the entities generate on their own in that particular case. And then number three, they could also receive some grants and donations specifically. In either case, sometimes you will see maybe other income as a line item. If there is anything like that there, like other income line item, no problem. We're just going to be bringing it as a line item on the face of the statement of financial performance. That is the idea about the way we deal with the revenue when it comes to either we are in a covered entity or we are on the consolidated fund. Now, remember, from a consolidated fund perspective, the central government can give out grants. So you have to be careful about the word grants. You have to be careful about the word donations. Because when we are giving a trial balance, we said that whatever is on the debit side can be an asset or an expenses. Whatever is on the credit side will be an income or a capital, or if you want, a liability. So if we see a line item like say grants or donations, and there is a figure on the debit side and there is a figure also on the credit side, it means the figure on the debit side is an expenses. Then the figure on the credit side is going to be part of their revenue. So remember, both covered entities and the central government, when we are doing the consolidated fund, can all have grants and donations on the debit side or the credit side. You must know if it's on the debit, that's an expenses. If it's on the credit side, that's a revenue. That's very important. Now, what if it's not a trial balance? It's just an extract. Then in that case, whatever swag you choose, you are correct. Okay, in that case, whatever swag you choose, you are correct. So if it's not debit credit, it's just an entry given to us, then you see grants. Then if you decide to treat it as an expenses, you are right. If you decide to treat it as an income, you are equally right. So if it is just balances extracted, boom, no problem. You choose, decide wherever you want to be at, but you are right. You are right. But if we are giving the trial balance debit credit, then it is important then to know about that in that particular case. Yes, Samuel.
Good evening, Shah.
Yeah, good evening.
Please, I've come again on my question. Decentralized transfer. Yeah. For example, a hospital paying salaries. We know that the salary of employees are paid by go- the government, but the question they don't specify. They say salaries of salaries. Then it will be at the debit side. So at this point, are you considered that is the government who paid? So we credit our revenue, then after that we go and credit our expenses. We go and debit our expenses.
Every covered entity will handle their payroll as far as they are able to generate revenue. That is the assumption we used when it comes to the examination. So if it is
Okay.
salary of established post, that is going to be part of their compensation. It is only when we are told that, or in the note, you are told that the government made the payment on their behalf, or the government made payment for wages and salary, then it will be treated as decentralized transferred and treated as compensation of goods and services. Sorry, compensation of employees.
Okay, Insha, thank you very much for the
Okay,
clarification.
okay. So the examiner must get excited and give you trial balance. Okay, oh, that won't be bad. You know, that won't be bad. Other than That swag not there. We don't want. I don't want the one that you use your own judgment. Eh? It depends. The examiner has done either. It could be a trial balance for you to work for, or just an extract for you to work for. When the extract comes, sometimes it's difficult because Charlie, when the thing is on the debit and credit, sometimes it's easier for you to easily classify. But if it's just an extract, now you have to think, hey, this entity, this thing, is it an income for them or is an expenditure for them? So really, when the extract is given like that, it's a bit challenging. It's a bit slippery. But you know, if the examiner wants to get excited with you, then he will do that. I would do that any day if I was the examiner, but I'm not, so I can't do it. All right, so that's revenue recognition, and the classification is very important. And like I say always, it's important you understand the classification. Then you come to the expenditure side. For the expenditure side, the fun part is that it's almost the same whether we are on the central government level or we are on a covered entity level. It's almost the same. So we're going to have compensation of goods and services, compensation of employees, goods and services, consumption of fixed assets, social benefit. Note that social benefit is simply an expenditure that the government or the covered entity incurs to provide some sort of relief to the less privileged in the society or in the community. So when they are giving relief to the less privileged in the society or in the community, then we are talking about the issue in respect of social benefits. Okay, so the expenditures are almost the same. We don't need any miracle on that one. The only thing you must understand is the treatment of the notes, which we've spent time to look at a couple of the notes. If they receive a donation but they have not done the work yet, they've not met the criteria yet, then that donation cannot be part of the revenue. Instead, it must be recognized as a deferred income, a liability on the face of the statement of financial position. If they have done the work, but the donation is yet to be received, then if it is certain that we will receive the donation, then it will be part of their revenue and also part of their receivables. So we've explained a lot of these principles, but that's the idea about question 2. Then the last thing could be the preparation of the cash flow statement. It's one of the statements that the examiner has never spoken about when it comes to dealing with statement public sector accounting. But a cash flow statement is also something that we could be asked to prepare, and it work with the same way in your financial reporting class. We're going to do operating activities, investing activities, and then financing activities in that regard. And the operating activities will be, and since it's a cash flow statement, you're going to be applying cash basis of accounting in the preparation of the cash flow statement. So under the operating activities, this is where you will see all their revenue that they got during the year from their operating activities will come there. So if it's on the central government level, direct taxes, indirect taxes, grant and donation, then non-tax revenue that relates to the day-to-day running or finance of the entity's activity. Then the expenditures based on cash basis, the normal expenditures that they undertake. When it comes to the investing activities, if during the year they receive any investment income, although that is a non-tax revenue, it is not part of the day-to-day activities of the entity, so it will not be under operating activities. Dividend income or interest income that they receive will rather come under the investing activities. Then if they acquired any assets during the year or they disposed of any asset during the year, all that will come under the investing activities. Then the financing activities in the public sector will talk about receipt of loans and repayment of loan. So if during the year the entity repaid some of its loans, financing activities. If during the year they received some loans, financing activities as well. So that is also the idea about a cash flow statement. You know, that's it. So it's just like what you know in FR, but there's a little twist here in respect of when it comes to the public sector in that case. So that's question 2, and what we need to understand when it comes to question 2. Asante, please talk about a cash flow statement. I think I just did. We have migrate already. Examiner should not come and add up. Migrate from where to where at this point? Derek said what? Inshi, how about an asset with both debit and credit? Okay, so if in the trial balance there is an asset, that's a good question and something you need to pay attention to. So you have an asset, maybe vehicle. Then there is an amount on the debit side, there is an amount on the credit side. The deal is that when it comes to an asset, non-financial assets like that, and we have debit and credits, the debit is the cost of the asset. Okay, Derek? The amount on the debit side is the cost of the asset. Then the amount on the credit side is the provision for depreciation. Okay? The accumulated depreciation brought forward. Does that make sense? The accumulated depreciation brought forward. So the amount on the debit side is the cost of the asset. Then the amount on the credit side is the provision for depreciation brought forward. It means that is how much depreciation has been charged on the asset uh, up till the beginning of the year. So if an asset debits credit, that's how we do the move there. Okay, so that's the issue about that. Let me know if that makes sense. Yes, Laudia.
And please, I'd like to ask this question. With the cash flow, you were saying that the operating activity record all the revenue and expenditure. And I wanted to find out if you're supposed to add back the revenues and um, subtract the add back the expenditure and subtract the revenues, or what is the treatment?
I don't understand. When you say add back the revenue and subtract expense, I don't get it.
You see that with financial reporting, when like something like receivables, when
No, no,
it's
no, 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 no,
increasing,
no,
um,
no, 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 no. Here, we are not going to start with anything like the net profit or whatever the heck. We'll just go straight up to cash flow from operating activities. Then we'll bring the revenue. Direct taxes on cash basis will come. Indirect taxes on cash basis will come. Any grants or donation we receive on cash basis will come. Then non-tax revenue that relates to the day-to-day running of the entity will come, that they have received will come. Then the expenditures will come, employee compensation or compensation of employees that they have paid, excluding anything in the notes, will come. Goods and services will come. Depreciation will not come here. Interest expenses that they have paid will come. Social benefit that they have paid will come. That's what will come under the operating activities. So you're going to bring the individual items and not start with anything and add back anything. So here we don't do movement in working capital usually. It's just the default issue. So the operating activity is like the organic day-to-day running of the organization. How much revenue came in? How much expenditure did we pay? That relates to the day-to-day running of the organization. Does that make sense? Let me know.
yes, please, yes, please.
Okay.
Also with depreciation, the depreciation aspect, when assuming a vehicle, then there's a cost, there's a accumulated depreciation, there's the depreciation percentage or years, and also they add another vehicle to it. Are you supposed to add that amount to the original cost and depreciate, or you only depreciate the initial cost?
No, you add because any addition will be added and we charge depreciation. So you bring the balance brought forward of the cost, then any addition during the year will be added so that you get a restated amount. And because usually the depreciation will be on a straight line basis, you're going to charge the depreciation for the year. Okay, whatever thing that is given to you, charge it, then you less. Then you bring the accumulated depreciation brought forward, which was given in the trial balance, and then you will now get the carrying amount. Now, this is if the asset is being depreciated on a straight line basis. But if it being depreciated on a reducing balance basis, then the accumulated depreciation would be deducted, right, before you charge the depreciation for the year, just like how you do in FR. But if it's on a straight line basis, then this is how we go with the flow. Add the addition and then charge your depreciation. Then you can less the accumulated depreciation brought forward. Let me know if that makes sense.
Yes, please.
Okay.
I'm okay. Thanks.
All right. Please, if the cash flow is for 3 months, what do we do? I don't get a context of that. Cash flow is for 3 months. What do we do? I don't understand that. Maybe give me some context of what they are trying to say in that particular case. If you are preparing cash flow for 3 months, I don't know what you mean though, but if the results given is per annum and you are preparing for 3 months, then you do 3/12. But like I said, I don't get a context of your question. Maybe you can give me some specification or clarity on that. Yes, Nathan.
Okay, Nhyira, please, I want to talk about the exchange transaction. When we are preparing the cash flow statement, are we not going to eliminate it?
Eliminate
Since
what?
there is no exchange transactions.
What is non-exchange transaction?
I mean, transactions like maybe they made a donation to the entity. So with that, we add the donation. Like if it is a vehicle, we add a donation to how do you call it? We add the vehicle to the pool of vehicle that we have, and also add it to donation as part of revenue. So I'm asking, if you are preparing the cash flow statement, are we not going to eliminate that?
What are you eliminating? Like, on what
Like,
basis are you eliminating what? Because if you remember the pro forma I gave here, we said we are preparing the cash flow statement on a cash basis. So you are bringing the individual figures, direct taxes, the direct tax that we paid, indirect taxes, the direct taxes that we received, indirect taxes, the ones that we received, grant and donation, the cash in respect of the grant and donations that we received, non-tax revenue, the ones that relates to the day-to-day running of the organization. That is what you are bringing. So when you say eliminate, donate, I don't get what you are saying.
like I'm trying to refer to those non-exchange transactions, like the entity is not actually paying.
Eliminate how? I don't get it. The thing is a non-cash item, so you don't bring it in the first place in your cash flow schedule. So when you say
Okay.
eliminate, it's like you are starting with something, and so you are now coming to eliminate it. But here, unlike FR, where we will start with the profit before tax and come and adjust for depreciation, finance costs, and all those things, here under operating expenses, operating activities, we go straight and then bring the items based on the cash that we have received. So if there is donation that we got, it's a non-cash item. Hence, it is not going to be coming anywhere in the cash flow statement. So no elimination, no adjustment. It's not a cash
Okay.
item, so it won't come.
That's what I'm trying to say, and I'm saying elimination. I'm just trying to say that it will not be included.
Oh, okay.
I think the person asking the question about the budget was the person asking the question was referring to cash budgets rather.
Oh, okay. I see.
Mm.
Yes, Nana Joa.
Okay, Isha. When there is an addition to non-financial assets, like let's say in the financial year from January to December, and so when the addition came around, let's say September, so from September, October, November, 4 months, when we are providing for consumption, are you supposed to do pro rata?
You said if the asset was what?
So when the asset came in, like addition was in somewhere around September.
Right.
So the financial year is from January to December. So that means for consumption, we have to do pro rata, right?
Yeah. No, it depends. There are two ways. If you do pro rata, you are right. If you charge a full year depreciation, also you are right. Because most of the time, there is a policy that is available that full year depreciation is charged in the year of acquisition of the assets, none is charged in the year of disposal. So if you do pro rata, you are right. If you charge a full year depreciation, also you are right. It's acceptable.
But if it doesn't say anything in the question, what do we do?
Choose whatever the heck you do is correct because it's correct.
Okay. Okay. And then with the inventory,
Uh-huh.
if they don't say anything about being held for sale or being consumed in the production process, we just assume that it's like
No, you can't assume. You have to look at the entity's operation and what we are talking about. Because if it's a hospital and the inventory there is drugs, the hospital doesn't eat the drugs, they sell the drugs, isn't it? So the drugs will be valued at what? Lower of cost and net realizable value.
it's realizable value.
But
Okay.
then if we are told that, oh, the hospital bought some stationery, pen, office, those ones they use it to run the hospital. Hence, we know they are not going to sell it. So if the question is quiet, you must look at the characteristics of the company and of the entity and the inventory in question and find out, will this entity sell this type of inventory or use it in the day-to-day running of the organization? And that will then guide you to be able to determine which model of valuation to go for.
Okay. Thank you.
All right. Any other questions on the final account situation? Because I'm done with the question 2 there. Yes, Nana Joa.
HR, sorry, it's the old one, so I'm just trying to mute
Okay.
myself.
Bye bye. All right. So that's it about the question 2. Why? Nana Joa. Okay. Yes, Laudia.
Yeah, please, I want to find out this thing. Assuming salaries has been paid and there's an arrest, what will be the treatment? Like, what's the treatment for that one? Then also, maybe there's a particular payment or something, that there was a prepaid or there was an advance to be paid. What will be the treatment? That is prepaid and advances. What will be the treatment in here?
Okay. Anything in the notes must be treated twice. So any expenses that is outstanding, we will add it to whatever expenses that it belongs to. So if you are saying that, oh, there is a wages and salary that is outstanding, then we'll add it to the compensation of employees. If it is interest that is outstanding, then we'll add it to the interest payable figure. Then it will also be added to the payables, which will go on the face of the statement of financial position. Now, if it happens that we have done a prepayment, that means we've paid more than we are supposed to pay. So what's going to be happening is that you will less it from whatever expenditure that it belongs. So let's say goods and services, and they said, oh, the entity during the year has paid, for a workshop, which will be running over 2 years, but the entity paid for it, but it will be running over 2 years. That means we have to prorate it. Hence, we will less that prepayment component from the goods and services, and then the corresponding entry will go under receivables, which will go on the face of the statement of financial position. So that's how you deal with the prepayment and then expenses owings. Let me know if that makes sense.
And also, if there's a transaction that occurred in the previous years and however was not recorded, that one to what is the procedure?
That will affect your accumulated fund. It's like in FR, you know, you do that in retained earnings. So any transaction that was supposed to have been accounted for in the previous year, which was not accounted for, we're going to be adjusting for that in the accumulated fund. So let me give an example. Let's say that there was a wages and salary figure of 10,000 that they didn't recognize and now they are recognizing it. It means you bring your balance brought forward on the accumulated fund. Remember, it could be positive or negative. Be careful, whatever the heck it is. Then these expenses that they didn't recognize, it means that if the accumulated fund is, it means they have understated their expenditure, so they increase the net operating result. So they didn't recognize this, so we have to come and less this particular what expenses, wages and salary from the accumulated fund before we can add the net operating results for the current year, so that we'll get a closing balance that will go on the face of the statement of financial position. So anything that was supposed to be occurring last year which wasn't treated, it will be adjusted for in the accumulated fund in that case. Or they bought an asset but they didn't account for the asset. They bought the asset last year, they didn't account for it. Okay, which means last year they didn't charge depreciation. So you have to now bring the asset as part of the non-financial asset workflow and charge the depreciation for last year. But the last year depreciation again will be less from the accumulated fund brought forward. Then you can continue with your schedule for the current year on the non-financial asset schedule. So that is the idea about these kinds of things. So any error or mistake that occurs in the previous year financial statement, which we are now recognizing it, it's going to be adjusted for in the accumulated fund, and its corresponding entry, if it has to be adjusted for in inventories, it will be adjusted. If it is non-financial asset, it will be adjusted. That's the idea about that. In other words, in the current year statement of financial performance, nothing about that will come there. That's why we would rather adjust the accumulated fund. So that's the issue about that. Let me know if that makes sense for you.
Thank you.
All right. What the heck do I have again? You people, I have to let you go and sleep. Ade, Nanajua is giving us pressure. Ayo. This pressure there. Rita said, Nhyira, what is the treatment if part of the equipment is destroyed by fire in the subsequent year? It will be stated in the question what the heck they are supposed to do, but it's either it will be written off, so you subtract it from the non-financial assets and then bring it in the statement of financial performance as an expenses for the year. Okay, it will be written off. So you subtract it from the non-financial asset and treat it as an expenses and as an expenditure in the statement of financial performance. So that's the treatment for that. But then if it was insured, okay, there's an insurance on it, then we won't write it off. Instead, we'd have to recognize a possible deferred income to be received from the insurance company. So it depends on the scenario. If it is just, oh, fire has destroyed a thing, nothing, then it has to be written off. So you subtract it from the non-financial asset and then boom, bring it as an expenses or expenditure in the statement of financial performance. But if the asset was insured and the company is certain that they're going to receive the money from the insurance company, then it depends. They may have to recognize that as part of other income in revenue. Then it will be part of receivables on the face of the statement of financial position. So it's a little bit slippery floor, but it depends on the context of the question. But these are the options available for the treatment of such transactions. Give me a sec. Let me plug my device. Let me know if that makes sense. Okay, so I think we're good on the financial statement preparation. Okay, I'll say yes, please. All right, that's fine. Let's see if I have some other questions coming up from here. I don't know. Do we have some questions from YouTube that I can take quickly? Oh, la 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 la. Okay, let's see if I can take some questions quickly from here. Also, then, good evening, sir. From Lagos. Yo, yeah, that's it. You are welcome. Carlson said, "Good evening, Shira. How do you spell my name like that? Spell my name well now, Carlson. This one is Hyra. Please, is any item with fund attached to it added to accumulated fund? For instance, petroleum fund. No, it's a fund on its own. Why will you attach it to accumulated fund? Petroleum fund is a designated fund on its own, so you can't put it under accumulated fund. Accumulated fund is like the equity in public sector. Okay, it's like the equity in the public sector, so it will be on its own. Nkrumah Derek said, "Good, sir." Okay. What else do I have? Raymond said, "Kindly share your match timetable." Yeah, you can send a message on WhatsApp on the number on my on the banner, and details will be sent to you, so you can see. What do I have? David said, "I have a question on depreciation. When is additional asset depreciated on pro rata basis?" I think I've addressed that question already. Uh, there is a policy that the full year depreciation will be charged in the year of acquisition, none will be charged in the year of disposal. So if you apply that assumption, then you will charge a full year depreciation irrespective of the time the asset was acquired. But if you apply the pro rata basis also, you're going to be correct because the two assumptions are acceptable. So I've already addressed that, David. Let me know if you are okay with that. So Raymond, you can send a message on WhatsApp on the number that you see on the screen. You can send a message on WhatsApp on that number. Details will be sent to you there. Okay. So that's question 2. It's been interesting. The kind of questions that you people are asking me is like, if people I've been solving some questions and some apobis trying to fly out in the spirit, but we move, we go. I have told you, don't start with question 2. May say then, don't start with question 2. Let that be your 4th or 5th question. You there, if you get to the exam hall, let something come over you and follow that thing and go and start with this question and lie to your brain that, oh, like I can do this right now. Easy. Okay. Okay. Your chances of passing will be like this. So please stay away from this question 2. No matter how fast you think you are, how sharp you think you are, thou shalt not do it first. It's my recommendation though, but as always, you people, you want my tummy to be big, you want me to have white beer. Before when I talk, you will listen to me. Okay, so that's question 2. Then we come to question 3. Question 3 is about performance evaluation generally, but the performance evaluation is divided into 2. PEFA, Public Financial Management System, assessing the efficiency and effectiveness of the public financial management system of the country, and then evaluation of financial statements. So there are 2 things here. There's a 10-mark question waiting for you on PEFA. Sorry. There's a 10-mark question waiting for you in the exam hall on PEFA. 10. And I've told you the way the question will be asked on PEFA during our mock discussion and our revision session. But it's 2 swags, 2 ways. Either it's going to be comments or theory, or it's going to be calculation and interpretation, right? calculation or interpretation. Very sweet, simple, straight to the point. Now, if it is about theories, then you know the things that are there. I mean, the pillars, the objectives, the critical performance dimensions. We discuss those things. Please make sure you read them. It's important. The examiner could go there for your 10 marks. Or calculation and interpretation. Now, that calculation and interpretation bit is also in two folds. Either you're going to be preparing the statement of budget performance, okay, statement of budget performance in a PEFA environment. Because remember, the examiner can ask you to prepare the statement of budget performance, but you won't interpret it using the PEFA issue. Now, if the examiner asks you to prepare the statement of financial performance and he wants you to explain it using the PEFA rules, he will give you the indicators. Let me just remind you, because some of you, I have to remind you about this one so that your brain doesn't do you, meko, meba. What the heck? Give me a full screen here. Right. This is the PEFA document. You have it already. Okay. I think what I want to say is above. Okay. Here. You know that in PEFA, give me a sec, maybe I'll come back to this. Let me finish the explanation. So the statement of budget performance, you'll be preparing that, or the examiner will ask you to assess the performance of certain indicators using various dimensions. So that is the calculation and interpretation. So either the examiner will bring you something to calculate and interpret, 10 marks, or written, pillars, objectives, another written aspect of the PEFA for you to answer. Now, in the calculation aspect, if you remember, we said we interpret it using A, B, C, D. Numerically, 4, 3, 2, 1. Interpretation-wise, this is very good. This is good. This is average. And this is poor. You got to be careful, because when it comes to the calculation aspect, where the second question or the second part, where you are doing the indicators bit, when you're doing the indicators bit, the examiner can ask you to use either the weakest link method or the average method. Now, if we are using the weakest link, then we will use the alphabets for the interpretation, for the calculation and interpretation. So in the weakest link, we say that a negative result in a certain dimension is going to be overshadowing or netting off with a positive result in another dimension of the same indicator. So in the weakest link, the way you do the naming is that you look at the things that are given to you, then you start with the lowest alphabet. So if you are given 3 dimensions under an indicator and the things are B, C, D, how do you name this? It's named as D, which means it is poor performance. What if it is A, B, C? Then you're going to start the naming with the minimum C. But because there are some positive in the same dimension, it will be called C plus. But C means the performance is what? Average. So that is the weakest link. You get it? Yo. In the indicator bit also, we could be asked to use the average method. If we are using the average method, then that one you just add up the results. You just add up the results. Again, the examiner will tell you whether you're using weakest link or average. You don't need a miracle for that. He will tell you. So if it is an average method, then if I have B, C, D, then I'm going to use the numbers. So B is what? 3, C is 2, D is 1. So when we add that up, it gives me 6. So 6 divided by 3, because there are 3 dimensions in that indicator, it becomes 2. The number 2 is equivalent to what? C. It means that particular indicator will have an average performance. That's it. Very sweet, right? Simple and straight to the point. The day they say, eh? What do you like? Very simple to understand. Very nice. Nice PEFA. So that is the second way, calculation and interpretation wise, the examiner will ask you. So we'll give you indicator, dimensions under each of the indicators. Then he will ask you either use the weakest link or the average method to interpret the financial performance of the entity. That's it. But the examiner can also ask us to prepare the statement of financial performance. In which case, you know the pro forma of the statement of financial performance? We can have the budgeted results. We can, or the revised budget. Then we'll bring in the actual, we'll bring in the out 10 in Ghana City, then out 10 in percentages. Okay? Then we'll have the, grading here. That is if we're in a PEFA environment. So you get the out 10 in Ghana City, but you need the out 10 in percentages. If it is in a PEFA environment, then remember you are comparing the revised budget to the actual, if we are using revised budget. But if there is no revised budget, then we are comparing the original budget with the actual results. Remember, the revised budget is the addition of the original budget plus supplementary budget. When we add the two, it gives us the revised budget. So if there is an original budget and supplementary budget, you add the results together, it gives you the revised budget. Then you can compare that with the actual and get your out 10. Note that your out 10 is your budget minus actual divided by the budget times 100. So you're going to get the actual in Ghana City, the out 10 in Ghana City, which means you are just doing the budget minus the actual. Then if you own the out 10 in percentages, then you go this way. You can be asked to prepare this statement and interpret it, not in a PEFA environment, just interpret it. And you know the rules for interpretation. But if the examiner wants you to prepare the statement of financial performance, the statement of budget performance, and use the PEFA principle to interpret it, then he will give you something like this in the question. So he will tell you that, let me scroll down and give you a real question here. So something like this. This is a question. You remember we solved this question in class. Then he will give you something like this, where he's going to interpret to you that, come on. Give me a second. Let me reopen the file. Make it bigger. Then he's going to tell you that, when you do the out 10 and it is between whatever the heck the score is A, or it's between whatever the heck the score is B, or it's between whatever the heck the score is C, that means you are preparing a statement of statement of budget performance, but you do the interpretation using the PEFA grading. So that is also PEFA, 10 marks waiting for you in the exam hall. Very sweet, simple, straight to the point. So either you're going to have a written comment, write English, or you calculate and interpret. And calculation and interpretation comes from two angles. Either you are preparing the statement of budget performance and using the PEFA principles to do the interpretation, or you are going to be given some indicators with dimensions under each of the indicators. Then you will use either the weakest link or the average method to do the interpretation. That's PEFA. Very sweet, simple, straight to the point. Let me know if there are any questions about that generally. Yes, book Samuel.
Yeah, Nhyira. Yeah, I remember we had one in our mock exams, but the solution, I missed the class. So I don't know if you can help me to trace the that particular session so that I can go and do a follow-up from there?
I don't think I can refer to that because we send the solutions out. So you can cross check if there's any specific issues you have, you can send me a message because I don't have that slide open up anywhere that I can refer to generally. So you can look at the solution if there's any specific issue you have, then you can ask me about it because I mean I didn't have that slide open up to solve any specific questions. So you can look at it if there's any specific question you have, then you can come and ask me about it. Certainly before tomorrow.
Okay. I hope that if I call,
Yeah, you
you
can send a
pick my
message
call.
or you can send a message or give me a call or something like that. Definitely, I'll be available. Yes.
Yeah, okay, sure. Thank you.
All right. Yes, Mawina.
Nhyira,
Hmm.
please. I was solving the question with 12 in class, the two district assembly. And I realized that when I was calculating, I got confused from the beginning. The license, I realized you said something about 3 over 10, but I couldn't recollect how we had a 3 over 10 because we calculated the question for 3 months. For the first quarter, I really got confused from the beginning. So
That
if you can throw
question,
more light
we were
at that side.
asked to prepare the statement of budget performance for the first quarter. And in the
Yes.
question, you were told that the budget allocation over the various items over the quarters are in this ratio. So it means the first three is for Q1, the second three is for Q2, the third number is Q3, the fourth number is Q4. Now, when you add these ratios up, it gives you 10. So it means the first quarter of the year, whatever the heck we are
Okay.
dealing with, is going to be 3 over 10 times everything of the annual
Okay.
budget.
Okay. Yeah, I remember now.
Okay.
Yeah, thank you. I was struggling with it.
All right. That's fine. Um, any other questions for me on PIFA? Let's see. I don't know. It's already 9. Can you imagine that? I have to leave you guys at this time and you guys should go and sleep. And now almost a day. Should I continue to go or I should leave you guys? Because I'm left with question 4 and then probably question 5. But if I have to leave you to go and sleep, that's also fine. What do you say? Should leave you guys to go and sleep anyway. Cause the idea So that's question 3, the first part. The second part of question 3 is evaluation of financial statement. The typical evaluation of financial statement. And there are 3 things there. Either we will be asked to do common size statement and analyze it. Okay. Now remember, when you're preparing the common size statement, the statement of financial performance, we will use total revenue as the basis. Does that make sense? We use total revenue as the basis in that particular case. So for each of the item, if it is a direct tax, the percentage of that is going to be the direct tax divided by the total revenue times 100. Now remember, the examiner can prepare the common size analysis for you or common size statement for you and ask you to do the interpretation. Now, if you remember, I gave you the principles on how to do these interpretations. Time will not allow me to go through those principles again. Refer to your notes because I gave you the principles on how to do that interpretation. Some of you, yeah, let me just see if I can gather my slide, get my slide on that and just pull it up and show you. Because sure you didn't give us any principle and you're saying that you're giving us any principle. What do you expect us to do? So this is what I told you. State the results, briefly explain the possible causes of the results, and state the implication of the score on the operation of the entity. So this is if you're in the PEFA environment. You state the score, briefly explain the possible causes, and then state the implication. I explained these things to you in class. Like I said, time will not allow me to go through that again. Make sure you get it right. Then, when it comes to the common size analysis and all that also, I gave you the principles for interpretation. I told you about it. Make sure you go through it. Okay? Time will not allow me to repeat these things, but make sure you go through it. Then I told you about your choices of words. If it is the same entity year on year, then it's a free range. Decrease, increase, higher, lower, rising, falling, whatever the heck happening, you can say it. But if you are comparing two different entities, two different countries, two different covered entities or whatever the heck, you are limited. You cannot say, oh, it is rising, oh, it is falling, oh, it is shan rising, oh, it is whatever the heck. You can only say higher, lower, greater, less, or better or worse. But I've told you, don't go and be writing that KG2 English. Oh, this means the entity has performed better. Don't go and be writing those things. Write proper English. Perform better, Orma better, Eyeye better, Bibia better. I mean, come on. Come on now. You're graduates. Write English that the examiner will enjoy. This means that the entity performed better than last year. This means that the entity, let's just say, Brofuna Utroni Nina perform better and kwa. Oh dear. Be writing that. I will knock you in the spirit when you are writing that in the exam. So these are the guiding principles, okay? I explained these things to you. So please make sure you go through them. In that case, let me go back to my slide. Where the heck I was? Sorry, where the heck was I? Dun 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 dun. Dun, 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 dun. Okay, I'm here. All right, so that is common size analysis. If we're in the statement of financial position, then the base amount will be total assets. Okay, the base amount will be total assets. Then, you do your interpretation. For the ratio analysis, there are a lot of them that the examiner can ask. The only thing that I want you to really be mindful of will be issues about capital expenditure, the calculation, and I explained to you during our mock discussion the context, because we saw a capital expenditure in the mock question, but we didn't go by the default calculation. So be careful about that. Then the other ratios, you know how to do the calculations, you know how to pick your figures, and then please, apart from debt per capita, apart from debt per capita, asset per capita, then GDP per capita, every other thing is multiplied by 100. These ones, the figures are represented in Ghana cedi. Okay, because you are dividing amount by the total population. Debt per capita, total public debt. Be careful about the public debt. I told you that if there is an interest-bearing debt, but it is under current liabilities, we will still consider it as part of what? Public debt. Don't go and add current liabilities. Don't go and add payables. So debt per capita, asset per capita, GDP per capita, those things, you got to be careful about them. But the other ratios, are going to be normal there. They are going to be in percentages, and then you go away. Then debt to GDP, the vice president's favorite ratio, just that it's been a long time since I heard him saying it. Now that he has been elected as the flag bearer, probably when he is doing his campaign, he will come back and talk about debt to GDP. Just that he cannot talk about this now because, the rate is very worse. So if he talks about it, it won't make any sense. So, but that is his favorite ratio, debt to GDP. please remember the threshold we set. We mentioned that when we are explaining the debt to GDP, anything about 60% means that there will be financial unsustainability. Hence, the country will not be able to borrow additional funds. But if they are going to borrow, that means their debt is not sustainable. So if their debt is not sustainable, if they are going to borrow additional finance, it will be at a higher interest rate. So remember the threshold for the, debt to GDP. Then remember the issue about this ratio also. Grant to total revenue or grant to tax revenue. It is the dependency of government on grants to finance its operations. And remember we said that anything below, 5 or 10% is not news. Okay? It's not news. It's not news. So those principles about the interpretation of the evaluation part, got to be careful. The budget variance analysis is the same as the statement of budget performance I spoke to you about, only that this time around you're not going to do the interpretation from the PEFA perspective. You do the interpretation from the organic analysis perspective. So pay attention to the context of the question. One of these three guys will be in the exam hall: common size or ratio or budget variance analysis, which is the same as the statement of budget performance without the use of the ratios. Sorry, without the use of the PEFA to do the analysis. Does that make sense? So that's the idea there. Then under the PEFA, we've said that two things can come there, and you have to be mindful of that as well. So that is question 3 and what we need to expect from question 3 there. From question 3 there. Then we go to question 4. Hey. Public-private partnership arrangement and public procurement. Okay? Public-private partnership arrangement and public procurement. I mean, we explained the various principles that you need to understand. Let's see if I have my slide coming up here. Okay, so it starts somewhere here. The structure of public procurement, we discussed this in class. And then the difference between single source and sole sourcing. Okay, so we said sole sourcing, that is the only person available, but single source, there are a lot of people available, but the procurement entity chose to go with somebody else. Then we mentioned the reasons for the single source. Then we spoke about the methods. Okay, the methods. Remember, we also discussed the procedures involved in competitive tendering. It's a question the examiner can ask you. So please make sure you go through that. We explained this. This is the procedure, and we explained it to you very well in class whilst we were having the discussion. Then the types of or the methods of procurement and the various thresholds. Please be mindful of that as well. We discuss these things in detail. So if it is, an international competitive tendering, what should be the threshold? You have to know about that and when it has to be used, because we can use the national competitive tendering if the contract value falls within these categories. We use international competitive tendering if the contract value is falling also in these categories. So it is important you understand these things, because the examiner can throw a question at you, give you some contracts, and then based on the value will ask you which method of procurement should the entity go for: national competitive tendering or international competitive tendering, and that will be based on the contract value. And there are other issues in public procurement. I mean, the role of the head of the procurement entity. I mean, disposal of government stores. It has come like 3 times in the last 8 examination dates, but it's something the examiner can still visit you there. So procurement, I mean, it's a lot. It's a very huge area, but it's important that you go through them very well in that particular case. So 10 marks is going to be coming from public procurement. Then the other 10 marks will come from our favorite topic, and that is public-private partnership arrangement. Do I have a slide on that? Public-private partnership arrangement. I should have a slide on that. Okay, I did that before procurement. Let's see if I can open my slide on that. Yeah, here we go, here we go, here we go. Public-private partnership arrangement. A couple of things here. The principles, okay? And I gave you a trick that the principles of public procurement and the principles of public-private partnership arrangement, they look alike. You just have to know the way to do the explanation. Because value for money is in public procurement and it is in public-private partnership arrangement. Accountability is in public procurement and it's in public-private partnership arrangement. Transparency and openness is in public procurement and it is in public-private partnership arrangement. So at least these three guys, you know, you can learn them so that either at public procurement or public-private partnership arrangement, you just have to contextualize the explanation to make it homey. All right. Just that when it comes to PPP, then we can have other principles like local content, ability to pay, you know, and all of those things. That will be the additions that will come when it comes to dealing with the public-private partnership arrangement. So the principles, you got to learn them. The objectives, we got to learn them. The limitations, you got to learn them. And then the types. Remember the way we learned it, right? So we bundle them together. Build, operate, transfer goes with build, transfer, and operate. The trick is simply when the transfer is occurring. Build, operate, and transfer, all of them are new assets. All of them will require the private investor to bring in money. All of them will require the private investor operating the assets to recoup their initial investment. All of them will involve the risks being shared between the contracting entity and the private sector. But the distinction between the two is that in build, operate, and transfer, the transfer of the residual assets occurs at the end of the agreement after the private investor has recouped his investment. But the build, transfer, and operate, immediately the asset becomes ready, the transfer is done to the contracting entity, then the private investor is given a right or the right to operate the asset for a given number of years to allow them to recoup their investment. So that's the distinction. Then we also put MO and SE together. Maintain and operate, and then your friend is saying service concession. In either case, there is an existing asset. In either case, that asset is not effective. In either case, we bring in a private investor. But the distinction is this. In maintain and operate is an agency relationship. So the private investor comes in to just provide the services that a public sector entity was providing previously, and we pay them. So under maintain and operate, the private entity doesn't put in any money. So the risk on the operation of the asset is solely borne by the contracting entity. But in SE, service concession, the private investor, yes, is given the right to provide a service, but would have to make some capital investment and is allowed a longer period of time, like 25, 30 years to recoup their investment. In maintain and operate, it's just 5 years. But in service concession, it's a longer period of time. The private investor invest money, and so there is a share in the capital of the share in the risk associated with the asset. So that is also these two guys bundled together. Then we spoke about BOO and ROT. There is no relationship between them. BOO is like one district, one factory. Build, operate, and own. Okay, or build, own, and operate. Here, the private investor builds the asset, constructs the asset, owns the assets, and operates it. What does the government get? They just get the support from the government in terms of financing and other policy guidance. And in return, they will create employment, and they are supposed to sell the things to certain industries or certain companies or to certain customers. That is boo. And a typical example of that is one district, one factory. You send your business plan to the Ministry of Trade and Industry. They look at it. If it's aligned with the government's objective, they look at it and direct you to go and take the loan from the participating banks. Now, if you go there on your own, they will give you the loan at, say, 40%. But under the one district, one factory, you can take that loan at the rate of, say, 25%. It means you are getting a reduction in the loan for 15%. That 15% reduction in the loan will be paid by the government to the participating banks. So that one, there is no transfer happening. It doesn't belong to the state. It's for the private, but the government is just empowering them through providing of loans, and they have to create job and help to solve the balance of payment deficit. Rot is there is an existing asset. It is not working. So we need someone to come and rehabilitate it, to come and revamp it. So here the private investor comes in, injects some money into it, and then boom, boom, boom. They are going to be revamping it. Then they're going to be allowed some significant amount of time to operate it, and then they recover their money. When they finish, we get a residual in the asset. So these are the types you got to understand. The boats, those are specialized contracts which will require the private investor to design it, to build it, operate it, and then transfer it also later on. So this question 4, what we need to understand in here, it depends on how excited the examiner is. We're going to have 10 from these areas, but under the public-private partnership arrangement, the types, they have come over and over again. The principles has been asked before, limitations, the objectives. These 4 areas, one of them or 2 of them will come for the 10 marks in the exam hall. You just have to understand the issues. And like I said, look at the way we did the types. Because I tell you always, you see, you have to learn how to read, and you have to learn how to trick your brain to understand certain things, because these things are not miracles. So if you're able to like bundle them like this and understand them like this, simple, then the principles, you don't have to necessarily learn all the principles under value for money and all the principles under public-private partnership arrangement. Like I've told you, 3 of the principles cut across. So those are going to be default at the back of your mind. Value for money is a default principle that must be in your brain. Transparency and openness, accountability. These are things you don't need miracle for. All you need is, how the heck can I explain this in the context of where I am asked so that I can get the marks? All right. So that's question 4. What the heck we are supposed to have there. Then the last thing is question 5, which is going to be no man's land area. Everything else that the examiner cannot ask you or did not ask you about in question 1, in question 2, in question 3, in question 4, he throws it into question 5. Any other thing in the syllabus. So it's a no man's land area. It can be the roles of the various guys. It could be issues about budgeting. It could be other issues that the examiner wants to get excited about. And that's it about that. So that's it about public sector accounting and finance. So, and I've told you this over and over again, right from session 1 throughout our revision. By now, question 1, you should know everything there. Question 2, you should know how you are playing there. Question 3, you know what is going to be there. Understand the principles. Question 4, you know what is going to be there. And okay, that is what it is. You know what's going to be there. Question 5, you know it's a no man's land area. Any other thing in the syllabus, this is where the examiner will share his feelings. Any other things that he wants to break your brain with, this is where he's going to bring it. So my recommendation is this, as I've told you already. In the exam hall, depending on how excited you are, you can take question 1. It's written aspect. There could be calculation, like I told you, because you may have to do the calculations and determine whether, which measurement method. So there could be some slight calculation in question 1, but 99.9% of the time is a written or comment area and we have discussed it. So from question 1, you can come to question 3B and come and check out the PEFA. If it is a written PEFA issue, then you can attach it. If it is not a written PEFA and it's a calculation PEFA that requires interpretation, stay from that a little bit, because the interpretation, you have to speak a lot of English. So you want to reserve that a little bit. Then question 4, PPP and public procurement. Come and see what is there. Answer them as fast as possible. Go to question 5, the no man's land area, and answer the ones that you can answer. So you want to take out all the written or comments questions 1, 3B, 4, and 5. When you are done with these things, then and only then can you come back to the question 3 and come and look at whatever is there about the evaluation of financial statement. Is it ratios? Is it common size analysis? Or is it a statement of budget performance? Then you can decide whether to do that first, do the calculation and do the interpretation, or to go to question 2, financial statement preparation. Please, don't be in a hurry to go and do anything in the financial statement. You won't score any marks. Like I said in the mock, some people just rush, prepared a statement of financial performance, wrote revenue, and then they listed the items. Do you know what that is called? It's called ENFA. That's what it's called, ENFA. Because you have to categorize the revenue. You don't get any score by saying, oh, statement of financial performance, revenue. Then you are just writing the items without any categorization. Yeah, them. So by the time you come to the question 2, all other things being equal, you have like 30 minutes or maybe 40 minutes to go. And you just have to take your time, do the workings based on whatever is there. Just take your time, do the workings, do your classification and all that, and go away. That is my recommendation. That's my recommendation. And as always, that's what I can tell you. If you go to the exam hall and something falls on you, and you go and start with a question 2 first, or you go and start with the evaluation of financial statement first, that's a what drain lock here. Maybe you will appreciate what I'm telling you. But to prevent that, make sure that you start with what you can do best first. Which means if you think the question 2 you can do it best first, it's your life. I pray for you. Everything is going to be fine. If it is the question 3, the ratios or whatever the heck will come, that is what you can do first. I love you. Go for it. It's your choice. But left with me alone, let these guys be your last or your last but one question after you've taken all the written part. The reason is because I don't want you to have a broken heart and go through emotional trauma before your results are released. Because you finish writing the exam on your way home, or whilst you reach home, you take the paper you are looking at, only for you to see that there is question 5B. It was something that you had read all night, but you didn't answer it, and you wasted the time on the question 2, which you didn't finish, or on the ratio, which you didn't finish. That emotional trauma, that broken heart is painful. And there you know that it's over for you. But you still encourage yourself and hope that everything will be fine. I don't want you to have that broken heart or that regret. That is what I'm saying. Ignore those calculations part. Take away all the written ones that you can do best first. My recommendation is just make sure you are answering each question on a fresh page. You are not supposed to answer questions in any order. Just make sure the questions are answered on a fresh page. Then, between the same question A and B, you leave 4 lines just for professional presentation purposes. Then you continue. So that's my take about that. And that's all about public sector accounting and finance. And we hope that you will follow this and be guided by these issues as you go into the exam hall tomorrow at 9 a.m. All right. And wish you all the best. And go and make yourself proud. Make sure you don't have any broken hearts after the exam. Okay? Like I said, I keep on telling you, just take your time, make sure you control your emotions, make sure you have your best state. That's it. If you start with a question and you realize that upon embabioma, chai, go to another question. Don't waste your time on something. Okay? Don't waste your time on something. If you're writing something and you feel it's not coming again, stop it and go to something else, because you don't have time to waste. If care is not taken, by the time you realize they say 1 hour more and you have answered only one question and you're on the second question, you will start panicking because you know you have failed already. Only that you can't tell anybody about it, but you know you have failed. So please make sure you control all the ups and downs that you're going to have. Okay? So that's it about that. What do I have? So then, please, any mark for professional presentation? Yes, there's. I've told you that over and over again. There's a 10 marks available in the exam hall for professional presentation. Okay, so after the script is marked, they go through the script to look at orderliness of presentation, handwriting, and all that. Then you can get some up to 10 marks. Okay, to do that. All right, so and that will help you to go in that regard. I'll say that I will leave good space. It's not about leaving good space. It's just about having um, your presentation in an orderly manner, having a clean handwriting, and not canceling things like, children canceling things. Some of you, when you cancel things, it's like, my goodness, you're in KG3. Some people cancel. No, if you're canceling something, one line, clean, and please make sure you use a good pen. Some of you, some pen be that your grandfather used. That's the same pen you are going to use tomorrow in the exam hall. Then the pen is deep. It is deep, like it's coming. The ink is flowing like water. That one, if you cancel na book na chaka, use clean pen. Have clean handwriting, so that you can go and make yourself proud. So that's it about that. Good night. Go to bed. Make sure tomorrow you have a great breakfast, and be in a good state of mind. And we wish you all the best. Au revoir. Also, then, the clean pens are not fast. See this girl. How do you tell me that a new pen that you've bought is not fast? Like how? Like, say you've bought a new pen and you're using that new pen, it's not fast? How? Yes, Ernestina.
Yeah, especially big pen. By the time I will write, maybe the boy is going to school. If I was using Shanghai, come a show one paragraph.
Hey,
Big, yeah.
yo, Mati.
Mhm. So the pointed ones,
Yo,
but that one to antenna in adults.
ayo. Whichever will work for you, do it, but make sure that you are doing the right thing. I don't know that there is a pen even called Shanghai. Hey, we are seeing who? Yo, yate.
Oh, sure.
Yate.
You went to early, that's why.
Say, and the big nana in him, him say, Freddy be Shanghai. And him say Chinese for us that a pen bisa. Minim tiate. But whatever be the case, whatever works for you, even if the pen is deep and you are canceling and you cancel clean, okay, and you are writing and you take your time to write, it's still going to be beautiful. Although it's deep in pen, but whatever be the case, just make sure you are clean. That's all I'm saying. All right. Okay.
Okay.
Yo. Muni nyaminko namonda. Bye bye.